Okay, let's understand what RBI's moves yesterday mean for the infrastructure as well as financial sector. Parag Parekh, ED and CFO at Gammon Infrastructure, joins us on the show, and we also have with us Vikram Limay, Executive Director at IDFC Limited. Parag, let me start off with you first, and clearly, coming to the specifics of what RBI entailed yesterday, they've allowed foreign investors to pump in $12 billion in long-term infra bonds, having a lock-in period of 1 year and a residual maturity of 15 months. What does this mean for you guys, and what did you make of this move?
Morning, Ayasha. Morning, Nikunj. I think RBI has announced these measures to slightly improve better inflows into the country. But when you look at the infrastructure sector, firstly, ECBs by itself forms a very limited component in the overall macro infrastructure space. Especially when you look at some of the sectors like transportation, they are completely dominated by Indian banks. ECB is more seen as an alternative to the domestic financing, especially in sectors like power and aviation. And to that extent, though ECB limits have been improved to improve the flow towards the country, I think what we need is slightly more macro reforms so that the industry and the sector has been attracting a far larger liquidity, both domestic as well as internationally. They have also announced measures with respect of inviting monies into infrastructure debt funds and mutual funds where they hold at least 25% of holding into the infrastructure space. And whilst these are, smaller measures, I think it is too little, at least at this juncture, and a little late. Yes, there are further promises, and we'll expect to see what more is coming in.
Morning, Vikram. Nikunj also joining in from the Mumbai studio. Now, Indian companies in the manufacturing and in the infra space which have a foreign currency earnings can avail ECB to pay the outstanding loans, and the ECB ceiling has now increased from $5 billion to $10 billion. How do you think this will change life for IDFC and for the infra companies?
Well, I think the reality is that today the risk limits and the credit available for Indian companies and Indian issuers from the European and American banks has actually gone down quite a bit given their own capital constraints internationally. So I think the traditional lenders to ECB have less money available for Indian issuers. The reality is that the issuers and the people who were getting money from the ECB market were the higher quality issuers out of India, the AA, AAA type of issuers. And for them today on a fully swapped basis, I think the rates available in the domestic bond markets would be a lot more attractive than the rate available to them on a fully swapped basis in the international markets. So I don't think it's going to be necessarily cheaper for companies to be borrowing offshore to repay domestic debt, unless you are really borrowing high-cost domestic bank debt. But the higher quality issuers do have access to domestic bond markets, and the rates available there would be much cheaper, given that credit spreads for Indian issuers have widened quite a bit in the international markets.
Vikram, the overall limit for FI investment in G6 as well has been increased. What's your take on this, and do you think the limit should have been more, or do you think it's sufficient to attract additional investments in the bond market?
From what I understand, the increase in GSEC limits is again something that is to attract sovereign funds and pension funds, etc., and not necessarily for the traditional trading FII community. So this is money that will take some time to come in. I don't think it would have an immediate impact on the rupee or on flows. Also, as you know, that the traditional FII investors in India have been interested more in shorter tenor debt rather than longer tenor debt. So from both those perspectives, I think while this might have positive implications longer term, immediately if you expect money to come from sovereigns and pension funds, etc., it may not happen as envisioned.
Parag, this is not 2008, this is 2012. 2008, just about everybody and anybody wanted to come to India. And right now the environment is that just about everybody and anybody, they want to get out of India.
Yes, that's right. And as I think Vikram mentioned, that we should not see any dramatic impact of this in the near-term future. The Euro as well as the Americas are having its own sets of challenges. And when it comes to India, even the credit quality in India as a macro perspective for its own internal challenges have gone down. And with the higher rated players, you are able to access the domestic bond markets, which in its own manner are active in a limited manner. So clearly there are enough challenges domestically, and whilst this does improve in terms of ceiling limits, but to expect that FII flow to come in immediately, I think is a little clearly down the corner.
Vikram, just want to bring you in. Qualified foreign investors can now invest in mutual fund schemes that hold at least 25% of assets in infrastructure under the current USD 3 billion. What is your view on this measure?
Again, this I think can have positive longer-term implications, but if the objective is to try and attract money in the immediate term in order to try and correct the decline of the rupee, then it's unlikely that you're going to see a lot of QFI money flow into mutual funds in the short term. Longer term, mutual funds will have to develop appropriate plans and schemes and market these schemes so that they're able to attract QFI money, and that could well be the case. But if you're expecting money to come in the short term from QFIs because of this limit having been increased, then that may not actually happen. On a broader note, what I would say is that I think the market was probably expecting a broader set of measures from the government, from a reform perspective as well as in terms of what it would do in order to stem the decline of the rupee. So to some extent, I think the market is disappointed by the kind of measures that have been announced so far. Not that they will not have positive implications longer term, but in order to have a more immediate impact, some of these measures may not have the desired effect.
Vikram, if the end objective of this exercise was to curb the fall in rupee, do you think the new initiatives from Reserve Bank of India will do precious little to stem the rupee fall?
Well, as I said, the market was certainly expecting a lot more. I do believe that the macro fiscal situation needs to be controlled in a better way to give confidence to markets and to investors that the fiscal deficit and the current account deficit is going to be under control. And I think the government needs to take some measures to give people that confidence. I'm pretty sure that the government is in fact focused on that. As the Prime Minister has also said, they are in the process of announcing a series of measures that will give confidence to investors and facilitate flow of funds into the country. So I think the market would be waiting to see what other measures the government would announce. Certainly the current set of measures could have positive longer term implications, but are unlikely to result in large capital flows in the immediate term.
But the government has also allowed QFIs to invest up to 3 billion now in mutual funds, which invest up to 25% in infrastructure, and the earlier condition where they could invest only in those schemes which invested 100% of their assets in infrastructure projects. Do you think this move should attract a whole lot of new investors to take their exposure into the infra space?
Yes, I think it will attract a newer set of audience in terms of investors. But as I just mentioned, that there are enough challenges globally, and therefore to expect immediate flow coming into even these MFs, I think is a little at a distance. So over a period of time, you should expect these measures to build strongly. But clearly, in a shorter frame, I don't see any dramatic impact of any of these measures. We are still, as I said, expecting a few more measures being announced quite soon. And hopefully that should more address the immediate measures in terms of improving liquidity and in terms of stopping the rupee slide.
So Parag, what is the bottom line here? RBI has done precious little to save the rupee from a free fall. None of the measures announced by Reserve Bank of India on Monday were path breaking. They are tactical and they are incremental in nature.
Clearly nothing that will see any immediate impact. These are being followed by other measures, and we'd like to sort of see how those measures are improving the immediate sliding of the rupee. But on a longer term, these will help structurally as well as in terms of especially the infrastructure sector where you will be able to invite larger flows as well as a larger target audience.
Vikram, how far do any of these measures help the cash-strapped infrastructure sector as well as IDFC?
Well, as far as infrastructure companies are concerned, those that are actually project companies developing projects, I think the appetite for infrastructure risk in the international markets is actually quite low. Also, many of the infrastructure companies are not going to be rated very highly in terms of being whether AA or higher in the domestic context. And so for the appetite for lower rated paper in the international markets is very limited. So I think it's not going to solve the problem for cash-strapped or stressed companies from a liquidity perspective. I think as far as IDFC is concerned, it's a completely different picture because we are rated in line with the sovereign and we are a AAA entity in the domestic environment. So for us, the international markets are open, but for us as well, on a fully swapped basis, the cost of borrowing offshore today is more expensive than borrowing domestically in the bond markets.
So, Vikram, what according to you would be most beneficial for the infrastructure to allow access to funds and reduce capital cost?
I think it's a combination of things. One, you certainly need to give people the confidence that the uncertainty surrounding the infrastructure sector, more broadly defined, are behind us, and that the quality of the assets and the credit quality of the companies is significantly better. The second thing that will need to happen is necessarily some of the structures that will need to evolve will require some sort of credit enhancement, because on a standalone basis they are unlikely to meet the sovereign credit rating of BBB- in terms of an international rating. So they will necessarily require some credit enhancement measures in order for these companies or infrastructure paper to be attractive for international investors.
Parag, just want to get you in terms of how much of an advantage do ECBs give domestic companies vis-a-vis borrowing locally, especially accounting for possible currency depreciation, which makes eventual borrowing quite expensive in turn?
Well, as I said, finally, when you look at infrastructure assets, there is a very, very limited appetite in the current scheme of things in availing ECBs. And fundamentally, infrastructure require long tenor investments. And the appetite further goes down the longer you go in terms of debt tenors. And which makes it far more easier, faster, and in terms of accessibility on the domestic financing. It also turns out to be cheaper when you look at a complete swap basis. So clearly, as I said, whilst there are ceiling limits which are open, still all in all, it is making sense for guys like us to look at an access on the rupee financing for projects. Secondly, one will also sort of need to understand that the inherent asset quality has not changed over a period of time. These are very strong, stable cash flows that are being churned over a period of time. I think it's all to do with the sentiment where some confidence measures need to be built up so that the sector starts looking back again.